Welcome back to the deep dive. Sometimes the market throws a real curveball, and Monday was one of those days we saw some pretty big swings in asset prices. But here's the thing. There was absolutely zero major economic news to explain it. It's like the market just woke up and decided to have a party for absolutely no reason. So today, we're putting on our detective hats. We've got this unusual market behavior, no clear culprit. Our mission, uncover the hidden forces at play so you can make smarter investment decisions.
I'm with you. When the market moves like this without a clear catalyst, it's like a puzzle waiting to be solved.
Exactly. So let's start by laying out the pieces of this puzzle. The US dollar took a little dip, down 0.7%. Now, that might not sound huge, but in the currency world, it's definitely something to notice. And as if on cue, US Treasury yields decided to join the party. The 2-year yield dropped 10 basis points, and the 10-year yield slid down even further, 13 basis points. Now, you might be thinking, what in the world are basis points? Well, think of them like tiny little units for measuring interest rates.
And this drop in yields is important because it usually means bond prices are going up.
Right. And that's exactly what we saw. Bonds, like TLT, had a nice little bounce back, up by 2.6%. So far, it kind of makes sense, right? Weaker dollar, falling yields, bonds doing their happy dance. It's a classic market move.
Like a well-rehearsed waltz.
Exactly. But then the music changes, and things get a bit weird. The stock market decides to join the party. With the S&P 500, NASDAQ, and Dow Jones all ending the day in the green, the Dow led the charge with a 1% gain. But hold on tight because this is where the plot thickens. Gold, usually safe haven when things get robby, decided to do a swan dive, plummeting by a whopping 3.4%. Even the VIX, our trusty market volatility gauge, chilled out, declining by 4.2%. Something doesn't quite add up here, does it?
It certainly raises some eyebrows. You see, a weaker dollar and declining yields typically make gold shine brighter, not send it into a free fall.
Right. It's like seeing a plant wilt under a gentle rain shower. It goes against what we typically expect in a risk-off environment.
Right. And just to throw another log on the fire, the Russell 2000 decided to have its own celebration, racking up an impressive 2% gain in early trading. But Bitcoin seemed to miss the memo entirely, dropping 3.4%.
It's like everyone got different invitations to this market party, and some folks decided to dance while others sat it out on the sidelines.
Exactly. To understand this market puzzle, we need to break down the timing and the sequence of these moves. That's where we'll find our clues.
Okay, so let's rewind the tape and zoom in on those treasury yields. The 10-year yield started its downward journey in the Asian session even before the U.S. market woke up. It's like the party started early without us.
And the reason for this early bird special? Well, it seems to be tied to our new Treasury Secretary and how the market views their policies. You see, under the previous administration, there was a lot of government spending, which led maybe to believe that interest rates would go up.
Right, because when the government needs to borrow more money, it has to offer higher interest rates to attract investors. It's like offering a bigger piece of the pie. But now, with our new Treasury Secretary taking a more restrained approach and aiming to reduce government spending, it's like they're saying, hey, we don't need as big a piece of the pie anymore.
And that shift in thinking, whether it actually happens or not, seems to have spooked the market, sending those Treasury yields tumbling.
It's amazing how quickly sentiment can change based on these perceived policy shifts, even before any concrete action is taken.
It really shows the power of expectations and how they influence what happens in the market.
Okay, so we've got these falling treasury yields. Let's bring in our trusty visual aid, the trusty market chart. Imagine this, a chart with 3 lines, like a heart rate monitor for the market. We've got the 10-year treasury yield in red, Bitcoin in blue, and gold in white. Now, here's how the story unfolds. Asian markets open, yields dip, and bond prices jump up. Gold initially takes a small step back, but nothing too dramatic. But then, late Sunday night, Eastern Time, gold takes a nosedive, things settle for a bit, and then bam, before the U.S. market can even blink, yields take another plunge, dragging gold further down with them. And finally, Bitcoin, our rebellious friend, decides to reluctantly follow the crowd.
What's really interesting is how this all happened in sequence, like a domino effect. First yields, then gold, and finally Bitcoin. This pattern, along with the fact that gold and Bitcoin dropped alongside yields, tells us this wasn't just a typical risk-off day in the market.
Because in a typical risk-off scenario, we'd expect investors to flock to gold, driving its price up. But this time, it's like everyone panicked and jumped off the cliff together.
Right. And if we look at the daily gold chart, that sharp drop completely wiped out the gains for the previous 3 days. It's a technical signal, and it often means we might see the price of gold continue to trend downwards.
So even though a weaker dollar and lower yields usually give gold a boost, it seems like there's a stronger force pushing it down right now. Something else is going on.
It's like there's an invisible hand pulling the strings.
All right, let's add another player to our chart, the S&P 500, represented by a pink line. Notice how closely Bitcoin's movements mirror those of the broader stock market. They're practically dancing partners, always in sync.
That close connection highlights how Bitcoin often behaves like a risk asset, meaning it tends to move in the same direction as the stock market. If stocks go up, Bitcoin often follows, and vice versa.
Exactly. And get this, even though the gains in the S&P 500 and NASDAQ were pretty modest, a surprisingly large number of stocks participated in the rally.
Right. It wasn't just a few big companies pushing the market higher. It was a broad-based move. That
Yeah.
tells us there's a lot of buying power out there, even if the overall gains weren't huge.
It's like a big party where almost everyone got invited.
And speaking of invitations, let's talk about this idea of market sentiment. It's basically a way to gauge how optimistic or pessimistic investors are feeling.
Right, like the mood of the party.
Exactly. Now, one way to measure sentiment is to look at the percentage of stocks trading above their 20-day moving average. It's a way to see how many stocks are trending upwards. And guess what? The S&P 500 closed at a whopping 82%. The Russell 2000 reached 75%. And even the NASDAQ, which has been lagging behind lately, came in at 58%.
Wow, those are some pretty high numbers. What does that tell us about the mood of the market?
Well, it's like the party is getting pretty crowded when you see those kinds of numbers. It often means that investors are feeling really optimistic, maybe even a little too optimistic.
So you're saying this could be a sign that things are getting a little frothy?
It's definitely something to keep an eye on.
Okay, so we've got this short-term sentiment indicator flashing a potential warning sign. But what about the longer-term view?
Well, there's this handy little tool called the CNN Fear and Greed Index, and it gives us a broader perspective on market sentiment.
Right, it's like a mood ring for the entire market. So what's the mood ring saying right now?
Interestingly enough, it's still showing signs of fear. This suggests that while there's a lot of short-term excitement, investors haven't completely shaken off their worries.
Interesting. So we've got these contrasting signals. Short-term sentiment is getting pretty heated, but the longer-term view is still a bit cautious.
Exactly. And this is where our new Treasury Secretary and their policies come back into play. This shift in expectations about government spending could be a major driver of this changing market sentiment.
It's like the new kid in town is shaking things up. Remember that scenario we discussed earlier about hedge funds potentially unwinding trades based on their previous assumptions? You know, those long Tesla and Bitcoin positions paired with short Treasury bets?
Yes, that's definitely a possibility. If funds were positioned for higher yields and a weaker dollar under the previous administration, this new direction could be forcing them to reevaluate their strategies.
So this shift in sentiment might not just be a fleeting moment. It could be the start of a bigger trend. Of course, as always, we need more data to know for sure. Speaking of data, let's shift gears and see what our friends at the Federal Reserve have been up to. We had two Fed members, Austin Goolsbee and Neil Kashkari, giving their 2 cents on the economy. What did they have to say?
Well, Kashkari's comments were particularly noteworthy. He's usually seen as being more hawkish, meaning he favors higher interest rates. But this time he hinted that a rate cut in December might be a good idea. Now, that's interesting because
Because it sounds a lot more dovish, like he's softening his stance.
Exactly. But here's the catch. The market didn't seem to buy it. Market expectations for a December rate cut stayed pretty much the same after his comments.
So it's like the market is saying, we hear you, Kashkari, but we're not convinced yet.
Right. It's like they're saying, show us the data, Fed. Prove to us that the economy is actually slowing down.
Fair enough. But then we have Fed Chair Jerome Powell, the big boss, who seems to be holding a more hawkish baton, keeping everyone guessing about a potential rate cut in December. So the December rate cut decision is still a big question mark. But wait, there's one more piece of the puzzle we need to fit in, and it involves our favorite electric car company, Tesla. What's going on with them?
Well, after the recent elections, there's been a lot of chatter about potential policy changes. That could shake up the entire electric vehicle industry. One hot topic is the $7,500 federal tax credit for EVs.
It's a big incentive for people to buy electric cars.
But they'll be on the chopping block.
That's right. And that has naturally raised some concerns about the future of EV adoption, especially for companies like Tesla, which have benefited greatly from these incentives.
So what does this mean for Tesla? Are they in trouble? Well, it's not that simple. There's another interesting development to consider. The governor of California, a state known for its love of electric cars, is reportedly planning to use state funds to support the EV industry.
So it's like a potential countermove, trying to offset any negative impact from the federal government.
Exactly. It's a classic tug-of-war between federal and state policies, with the EV industry caught in the middle.
And Tesla is right there in the center ring.
Exactly. Welcome back to the Deep Dive. Before we went to the break, we were untangling the threads of Monday's market moves and looking for potential explanations. Now let's shift gears and talk about what this all means for you, the investor.
Yes, let's get down to brass tacks. What should we be watching for in the coming weeks and months? What kind of clues can help us navigate this market maze?
Well, first, keep a close eye on the bond market. Remember how we talked about Treasury yields taking a tumble? If this trend continues, it could signal a broader shift in investor thinking, particularly about interest rates and economic growth.
Okay, so walk me through this. If yields keep falling, what's the message?
It could mean the market is starting to anticipate slower economic growth and possibly even more rate cuts from the Fed down the line.
Makes sense. Lower yields usually mean lower interest rates, right? And if the economy is slowing down, the Fed might cut rates to try to stimulate things.
You got it. And here's why this is important for you. When yields fall, bond prices rise, which means those safe haven assets are becoming more attractive. And this often happens when investors are getting a bit jittery about the economic outlook.
So bond yields are like a canary in the coal mine, giving us an early warning about potential economic shifts.
Exactly. Now let's connect this to gold for a second. The fact that gold took such a hard fall, even with the weaker dollar and falling yields, suggests something else is going on. It's not just a simple risk-off move.
Yeah, that was a real head scratcher. What are your thoughts on this gold puzzle? What's the invisible hand pushing it down?
It could be a few things working together. Maybe some big investors are reducing their gold holdings. They might be worried about the global economic outlook or a potential shift in central bank policies. Or maybe it's more technical, like the price breaking below a key support level, which can trigger automated selling.
So it's like gold is caught in a crossfire right now, with both fundamental and technical factors working against it.
It seems that way. But remember, gold has historically been a decent hedge against inflation and economic uncertainty. So even though the short-term outlook might be a bit cloudy, it's still worth considering as part of a diversified portfolio, especially if you're concerned about potential risks on the horizon.
Good point. Don't count gold out just yet.
Mhm.
Now let's bring back those market sentiment indicators we talked about. Remember, those are like our mood rings for the market. You mentioned that the high percentage of stocks trading above their 20-day moving average could be a sign that the market is getting a bit too hot.
Right. It's like a party that's getting a little too crowded.
So what's the takeaway for investors here? Should we be hitting the panic button?
Not necessarily. It's not a signal to sell everything and run for the hills, but it is a yellow flag, a reminder to be cautious. When sentiment gets too optimistic, it can set the stage for a pullback or correction.
Like that balloon analogy,
Oh,
right?
yeah.
Too much air and it's bound to pop.
Exactly. So if you're heavily invested in stocks, especially those that have seen big gains recently, it might be wise to consider taking some profits off the table. Think of it as locking in some of your winnings before things potentially get a bit rough.
Okay, so a bit of healthy profit-taking never hurts. But what about investors who are just starting to build their portfolios or looking to add to their positions? Should they sit on the sidelines and wait for a dip? Or are there still opportunities out there, even in this heated market?
There are always opportunities, but it's crucial to be selective right now. Don't just blindly chase trends or jump into risky investments because everyone else is doing it. Focus on finding companies with solid fundamentals, strong management teams, and a clear competitive edge.
So it's like being a detective, carefully examining the evidence before making a decision.
Exactly. And don't forget the power of diversification. Spread your investments across different asset classes, sectors, and geographic regions. It's like having a safety net. It won't prevent you from falling, but it can definitely soften the landing if you do.
Diversification, it's not just a good idea, it's essential.
Now let's not forget the elephant in the room, the Federal Reserve. The December rate decision is right around the corner. And as we discussed, there's still a lot of uncertainty about which way they'll go.
Yeah, it's a real nail-biter. Kashkari's comments might have thrown some people off, but Powell seems to be playing his cards close to the vest. What are the key things that will influence the Fed's decision?
The most important thing they'll be looking at is the incoming economic data. They'll be watching indicators like inflation, jobs growth, and consumer spending to get a feel for the economy's pulse. If the data shows things are slowing down, they might be more inclined to cut rates to give the economy a boost.
But if inflation starts to heat up again or the job market stays strong, they might decide to hold rates steady or even consider raising them.
Exactly, it's a delicate balancing act. They want to keep inflation under control without slamming the brakes on economic growth.
It's like trying to walk a tightrope, isn't it?
And to make things even more complicated, they have to consider what's happening in the global economy, trade tensions, and geopolitical risks. It's a tough job, but someone has to do it.
Speaking of tough jobs, let's loop back to Tesla and the electric vehicle industry. With all this talk about policy changes, how do you see the outlook for this sector?
Well, the EV industry is at a crossroads. The potential cancellation of that federal tax credit could be a major hurdle, especially for Tesla, which is relying on those incentives to boost sales.
But we also have California stepping up, potentially filling the gap with state-level support. It's like a tug of war with the EV industry caught in the middle.
It's a dynamic situation, and the outcome will depend on a number of factors, including the political landscape, technological advancements, and, of course, consumer demand.
So what are the key things for investors to watch in the EV space?
Keep your eyes peeled for any updates on the federal EV tax credit and how California's policies evolve. And pay close attention to Tesla's sales numbers and their ability to stay ahead of the competition as more players enter the market. It's going to be an interesting ride, that's for sure.
All right, we've covered a lot of ground here, but before we move on, I want to revisit something we touched on earlier. Remember how we talked about the market's reaction to the new Treasury Secretary and the possibility of hedge funds adjusting their strategies based on these new policy assumptions?
Yes, that was a key insight. It shows how shifts in political and economic narratives can really shake things up in the market.
Right. But what if this goes beyond just hedge funds? What if this shift in expectations starts to filter down to Main Street, to everyday consumers and businesses?
That's a great point. If people start to believe that the new administration's policies will lead to slower economic growth or higher taxes, it could influence how they spend and invest their money.
Right. Imagine if people start putting off big purchases like buying a house or a car, or if businesses hold back on hiring because they're worried about what's coming down the pike.
Exactly. That could have a real impact on the economy. And it could create a self-fulfilling prophecy where negative expectations actually lead to economic weakness.
So while we've been dissecting the market's immediate reactions to Monday's events, the real story might be unfolding more slowly and subtly, as these shifts in expectations work their way through the economy.
It's like a ripple effect spreading outwards.
Mm.
And while we can't predict exactly how it will all play out, it's important to be aware of these potential downstream effects and how they might influence your investment decisions.
It's like we're detectives gathering clues and trying to piece together a puzzle that's constantly evolving. Welcome back to the deep dive. We've spent this episode analyzing market movements and breaking down expert commentary, and even exploring those potential ripple effects that could be coming down the pipeline. But before we wrap things up, let's pull it all together and see if we can distill some actionable insights for you, our listeners. After all, that's what this deep dive is all about.
Absolutely. Let's take this complex market landscape and turn it into something you can actually use to make informed investment decisions.
Perfect. So first things first. We've got this mixed bag of signals. Short-term sentiment seems to be reaching a fever pitch, but those medium-term indicators are still suggesting there's room for optimism. It's like we're getting mixed messages. How do we make sense of it all?
Well, it's all about understanding the difference between short-term and long-term perspectives. Think of it like driving a car. You need to keep your eyes on the road right in front of you to avoid those immediate obstacles. But you also need to know where you're going and how you're going to get there.
So the short-term market movements are like the road immediately in front of us, with all those potential potholes and detours, while the medium-term outlook is our navigation system, guiding us towards our investment goals.
Exactly. And just like driving, you need to adjust your speed and course depending on the conditions. If you see a roadblock up ahead, you might need to slow down or take a detour. But if the road is clear and you're making good time, you can keep your foot on the gas.
I like that analogy. So how do we apply this to our investment strategy?
Well, if you're concerned about those short-term risks, like a potential market correction, it might be wise to take some chips off the table, especially if you've seen some nice gains recently. Think of it as locking in some profits before things potentially get a little bumpy.
Makes sense. Protect those winnings. But what about investors who are just starting out or looking to add to their portfolios? Should they wait for a pullback, or are there still opportunities to be found, even in this seemingly overheated market?
Well, there are always opportunities out there. But right now, being selective is key. This isn't the time to chase the latest fads or jump into risky investments just because everyone else is doing it. Focus on finding companies with solid fundamentals, strong management teams, and a clear competitive advantage.
So it's about quality over quantity.
Exactly. And let's not forget the importance of diversification. Spread your investments across different asset classes, sectors, and geographic regions. It's like having a safety net. It won't prevent you from falling, but it can definitely cushion the blow if you do.
Diversification. It's not just a good idea, it's an investment essential. Now, let's not forget the wild card in all of this, the Federal Reserve. Their December rate decision is looming, and as we discussed, there's still a lot of uncertainty about which way they'll go.
Yeah, it's like waiting for the judge's verdict. Will it be a rate cut, a pause, or even a surprise hike? We're all on the edge of our seats.
So what's the best way to prepare for this?
Honestly, the best approach is to be prepared for any outcome. Don't make investment decisions based on speculation or rumors about what the Fed might do. Instead, focus on building a portfolio that can handle different interest rate environments.
So build a portfolio that can weather any storm right, whether it's a gentle drizzle or a full-blown hurricane.
Exactly. And remember, the Fed isn't the only player in the game. Fiscal policy, what's happening in the global economy, geopolitical events, all of these things can impact the market.
It's like a complex dance with multiple partners swirling around the floor.
Precisely. So stay informed, stay agile, and don't be afraid to adjust your steps as the music changes.
That's great advice. And finally, let's circle back to those potential second-order effects we discussed earlier. Remember how we talked about the shifts in expectations triggered by the new Treasury Secretary and those potential policy changes? Those changes could ripple out and impact how consumers and businesses behave.
It's like tossing a pebble into a pond and watching the ripples spread outward.
Exactly, and it's important to be aware of these potential downstream impacts. Think about how they might influence the economic landscape in the months ahead.
Think about how they might influence your investment decisions.
Well said. So as we wrap up this deep dive, we want to leave you with this thought. The market is a dynamic, constantly evolving ecosystem. Stay curious, stay informed, and never stop learning.
And remember, the best investment you can make is in yourself and your understanding of the forces that shape the world around us.
Until next time, happy investing.